You've seen the video, 30 seconds. A guy in a bright kitchen tapping a whiteboard with a marker. "Zero is your hero," he says, and taps the board again. The market drops and your money doesn't move. The market rises and yours rises with it. No losses, tax-free income in retirement. He's not selling you anything, he says. He's just showing you what the banks don't want you to know. He sounds like a friend who found a loophole, not a salesman with a quota. Your thumb hovers over the number in his bio. You are one tap away from booking the call. What's the worst that happens, right? It's your own money. This is the moment to stop. Because right now, billions of dollars are pouring into this exact pitch, and almost nobody watching it understands the one number that actually matters. The number that shows up on a tax form years from now, long after the loan, long after the policy lapses, long after "zero is your hero" has been forgotten. Here's what's actually being sold. An IUL, an indexed universal life policy, is permanent life insurance with a second account attached to it called cash value. That cash value isn't invested in the stock market. It's credited interest based on how a market index, like the S&P 500, performs, up to a cap, with a floor that stops it from dropping below zero. You don't own stock, you own a formula. Markets go up, you participate, up to a limit. Markets go down, you're protected, down to zero. That part is true. It's also not the part that traps people. Notice what that formula is really selling underneath the math. Certainty, in a decade that hasn't offered much of it. That's not an accident. It's the entire reason this product is having a moment right now. The viral clips only tell half the story. So a few advisors who study these videos for a living have started mapping the other half, the script itself, because it repeats almost word for word from one creator to the next. Marketing consultant Sarah Grillo broke it into 4 moves. First, the knowledge drop. A term you've never heard, dropped early, so you assume the person talking knows more than you do. Second, the fearmonger. A real fact told incompletely, usually about market crashes or your 401k. Third, the whopping claim. You can't lose money on an IUL, said flatly like a fact, not a sales line. Fourth, the alternative. The policy itself offered as the fix, dressed up as education instead of a pitch. Watch for those 4 beats in the next one of these that lands in your feed. They're almost always there. Insurance analysts have watched the same pattern spread across platforms most people don't associate with financial advice at all. This isn't a niche corner of the internet, it's the main feed. And the feed is working, and that's the part that should give you pause. A recent industry survey found that 68% of millennials and 62% of Gen Z now turn to YouTube for financial information, with similar numbers on Instagram and Facebook. New premium flowing into these policies hit $4.5 billion in 2025, according to LIMRA, the life insurance industry's own research arm. That's up over 18% from the year before in a single year. 2 years, over $8 billion, a good share of it traced back to a phone in someone's hand at 11 at night, mid-scroll, not a meeting with an advisor in a beige office. Why now, specifically? Because 6 in 10 Americans, in a poll taken this June, said they expect a recession within the next year. Fear finds the message it's looking for. "Zero is your hero" isn't just a slogan. It's an answer to a question a lot of people are quietly asking themselves before bed. Insurance has always sold peace of mind. What's new is the delivery system. A 15-second hook, tested against millions of viewers until the highest converting version rises to the top of your feed. Almost every one of these videos ends the same way. Be your own bank. It's borrowed from a decades-old strategy called infinite banking, repackaged for a 15-second attention span. Borrow against your own cash value, tax-free, whenever you want, and pay yourself back on your own schedule. No bank application, no credit check, just your money on your terms. That loan is the entire second act of the pitch. It's also where the trap gets built. Before the part where that loan goes wrong, here's something worth having on hand before you ever call the number in one of these videos. A short, free checklist built around the 4 questions to ask first. It's in the pinned comment if you want it. Here's how the loan actually works in plain numbers. Say a policy has $200,000 in cash value. Over the years, you borrow $100,000 against it. A business, a home, an emergency, doesn't matter which. Nobody puts you on a fixed repayment schedule because nobody has to. Interest keeps compounding on what you owe, quietly, in the background, for a decade or more. Meanwhile, the cash value on the other side isn't guaranteed to keep pace. The same cap that protected you from losses also limits your upside in good years. And the cost of insurance, the part of every premium that actually pays for the death benefit, climbs every year you get older, quietly eating into the account from the inside. So the gap between what you owe and what the account is worth doesn't stay still. It closes, often faster than the 30-second video ever implied it would. Eventually, the loan balance catches up to the cash value itself. And that's when the policy doesn't just sit there, it lapses. Insurance language for the coverage collapsing because there's no longer enough value left inside it to keep itself alive. Here's the part almost nobody explains in the 30-second version. When a policy with an outstanding loan lapses, the IRS doesn't treat it as nothing happening. It treats the cash value as if it had been paid straight to you, even though every dollar of it went to close out the loan, and you personally received zero. Financial planner Michael Kitces walks through exactly this mechanics of phantom income. $200,000 in cash value, $125,000 in premiums paid in over the years. That premium total is your cost basis, the number the IRS lets you subtract before it counts anything as a taxable gain. The loan swallows the entire $200,000. You receive nothing. You still owe tax on a $75,000 gain you never touched. That's not a hypothetical built to scare you. It happened, on the record, in United States Tax Court in 2026 in the case Sawyer v. Commissioner. A policyholder had borrowed $80,000 against a policy. By the time it lapsed, the cash value had grown to just over $205,000. The cost basis was about $44,500. The court ruled the difference, exactly $160,900, was taxable income, not a gift, not a loan. Ordinary income, the same category as a paycheck. Run that through a fairly average federal bracket, 24%, and the real cash tax bill lands around $38,600. On money the policyholder never held in their hands. And here's the detail that should really stop you. That bill doesn't usually land the year you take out the loan. It lands decades later. 70 years old, 75, 80, exactly the age this policy was supposed to be paying you, not billing you. Think about what that means next to the original pitch. The whole promise was a stress-free income stream in retirement, pulled tax-free from a policy built to protect your family. Instead, for a policyholder in exactly this situation, retirement can open with a tax bill bigger than most people's annual salary on a policy sold years earlier as the safe choice. The thing that was supposed to remove risk from their life became the risk. So why is it legal to say all of this in a 30-second video when it wouldn't be legal to say about a stock or a mutual fund? Because of a regulatory gap most viewers never think to ask about. Selling stocks or funds requires a securities license and a fiduciary duty, a legal obligation to put your interest ahead of their own. Selling life insurance, including the cash value account riding inside it, doesn't require either one. Barry Flagg, a certified financial planner who has spent years auditing these policies, put it plainly. What these promoters are claiming would be illegal and sanctionable in any other segment of the financial service business. In this one corner, it's just another video on your For You page. Fiduciary duty is a simple idea with real teeth. It means the person advising you is legally on the hook if that advice serves them more than it serves you. The 30-second video you watched last night owes you no such duty. Legally, it owes you nothing at all. You'd assume the rules got stricter as the claims got bigger. They didn't. The claims got bigger because the rules never caught up. None of this means a loan against a policy is always a mistake. Some families use them well, with a repayment plan they actually follow and a clear reason for borrowing in the first place. The mistake is treating tax-free access to your own money as the whole sentence, when the real sentence has 3 more clauses hanging off the end of it. So before you call the number in the bio, 4 questions belong on your kitchen table, not the salesperson's. What happens to this loan if you stop paying it back, on purpose or by accident? Most people never ask because nobody plans to stop paying. Life has other ideas. What is this policy's actual cost basis today, not the day it was signed? That number moves every year, and it's the number your entire tax exposure is measured against. Who is legally required to put your interest ahead of their own in this conversation? And is it the person in the video? For most of these pitches, the honest answer is no one. And if this policy lapsed tomorrow, with the loan still open, what would the tax bill look like in real dollars this year, not someday? If nobody can answer that last one on the spot, that's your answer. 0 is your hero, the video said. And for the part he showed you, the part about market losses, he wasn't lying. It's the part after the tap on the whiteboard, the one the 30 seconds never had time for. The loan, the decade of quiet compounding, the form that shows up years later with a number on it you never agreed to. That part doesn't go away just because nobody filmed it. The whiteboard gets wiped clean at the end of the video. Your policy doesn't.